Okay, let's unpack this. Welcome to this deep dive. We're about to jump into the nuts and bolts of taxable and non-taxable income.
Right, and how that number you ultimately pay tax on is actually figured out.
Exactly. We're pulling from the source material you've shared, and our mission is, well, pretty simple.
Yeah.
Cut through the complexity, find the really important takeaways.
And help you feel a lot more confident about what the government considers income and, importantly, what it doesn't.
Yeah, think of this as building a solid foundation.
That's right. We'll explore everything from, money from work or investments to how selling property plays into the tax picture.
And even some surprising things, right?
Yeah.
Stuff you might not expect to count as income.
Definitely. And crucially, how certain expenses can actually help bring down your taxable total.
It's a bit of a journey through the tax landscape, starting with that big initial bucket of income and refining it down. So let's get started.
Okay. So the absolute core principle this source lays out is that under federal law, all income is considered taxable unless it's specifically excluded by law.
That's the starting point. Everything.
That's the default. If money or value comes your way, assume it's taxable unless you find a rule saying it's not.
That feels pretty broad.
It is. And this leads straight to a really critical distinction you need to grasp right up front. Exclusion versus deduction.
Okay, exclusion versus deduction. What's the key difference there?
An exclusion means that income isn't even counted in your total income for tax purposes. It keeps its non-taxable nature.
So it just stays outside the system entirely.
Exactly. It never really enters the calculation. Think like life insurance death benefits, generally excluded.
Okay, so invisible to the tax calculation. What about deductions then?
Deductions reduce your taxable income, but they happen later in the process. The income gets included initially.
Right.
And then you subtract specific allowed amount.
Got it. Excluded, invisible. Deducted, subtracts later.
Precisely. And knowing that helps make sense of the basic flow of how your income is calculated for tax purposes.
Okay, let's walk through that flow as the source describes it.
Right. It starts with gross income. This is that big initial bucket we mentioned.
Everything that isn't specifically non-taxable goes in here.
Yep. All income in any form, money, property, services, unless it's specifically exempt, wages, self-employment income, interest, dividends, capital gains. It all starts here.
Okay, gross income, check. What's the first refinement?
You subtract certain specific deductions, often called adjustments to income, or above-the-line deductions.
Like what?
Things like certain IRA contributions, some self-employed expenses, student loan interest. We'll get into more detail later. Subtracting these gives you your adjusted gross income, or AGI.
AGI. You hear that acronym all the time. Why is it so significant?
Well, because that AGI number often acts as a threshold, Eligibility for a lot of other deductions and credits is based on your AGI.
So a lower AGI can actually unlock more tax breaks later on.
Exactly. It's a really key figure in the whole calculation.
Okay, so gross income minus adjustments equals AGI. What's the final big step to get to the number that's actually taxed?
From your AGI, you subtract either the standard deduction for your filing status or your total itemized deductions if you choose to itemize, and they add up to more.
Whichever is bigger.
Whichever is bigger, right. And that final number is your taxable income.
And that's what the tax rates apply to.
That's the number. Tax rates hit that, figure your tax liability, then you subtract any tax credits.
Yeah.
That's the core structure.
Okay, foundation laid. So with that in mind, let's look at the different kinds of income. Because, like you said, not all money is treated the same.
Absolutely. A key distinction the source makes is between earned and unearned income.
Earned income is money from working.
Pretty much. Income you receive for services you perform. So wages, salaries, tips, income from your own business or freelancing. This kind of income is generally subject to Social Security and Medicare taxes.
I get taxes.
Right. FICA if you're an employee, or self-employment tax if you work for yourself.
Okay. And unearned income.
That's money you get from, not directly working for it at that moment. Think investment income like interest and dividends, retirement income, capital gains from selling assets.
And that stuff generally isn't subject to FICA or SE tax.
Generally, no. Both types still count towards your overall income tax, but that FICA tax piece is a big difference.
Okay. Now, there are also a couple of, let's say, timing rules about when income counts, right? Even if it's not in your hand yet. Constructive receipt.
Yeah, that's a big one for cash basis taxpayers, which is most individuals. It means income is taxed when it's made available to you without substantial restrictions.
So even if you Like, don't cash the check right away.
Exactly. If the money is credited to your account or available for you to pick up, you've constructively received it. You can't just delay taking it to push the tax into next year if it's already available. The source mentions income received by your agent counts as received by you too.
Okay, makes sense. You can't just ignore it if it's ready for you.
Right, unless there are real strings attached, significant hurdles to getting it.
Then there's the claim of right doctrine. This sounds a bit more complex.
It comes up when you receive income, pay tax on it, but then later find out you weren't entitled to it and have to pay it back. And we're talking a significant amount, usually over $3,000.
Like maybe a bonus you got by mistake and had to return.
Exactly like that. The tricky part is how you get tax relief for the repayment. The source points out a key difference based on the type of income.
Okay.
If it was self-employment income you repaid, you generally deduct the repayment on your business schedule, Schedule C. Relatively straightforward.
But if it was wages or something else?
That's where it gets, well, potentially frustrating. The source suggests that repaying wages or other non-business income, even over that $3K threshold, might not always be deductible in a simple way. There are special calculations you might be able to do under Section 1341, but sometimes you could end up having paid tax on income you ultimately gave back without getting a clear deduction for the repayment.
Ouch. So the type of income really matters if you have to repay it.
It really does. It highlights why these distinctions are important.
Okay, let's focus then specifically on income from work, self-employed versus employee.
Right. If you're working for yourself, freelancer, gig worker, small business owner, that's self-employment income. The source says if your net earnings from all that self-employment are $400 or more.
Just $400.
Yep, $400 net for the year. Then you generally have to file a return and report it, usually on Schedule C.
And that triggers self-employment tax.
It does. SE tax is basically your way of paying Social Security and Medicare taxes, kind of like both the employee and employer share combined. It's calculated on Schedule SE based on those net earnings.
Okay. The source had a really important heads up for married couples running a business together.
Oh yeah, this is crucial. If a married couple jointly owns and works in a business and they want both spouses to get credit for Social Security purposes.
This affects future benefits, right?
Hugely.
Yeah.
They need to calculate the SE tax separately for each spouse. Often this means filing 2 Schedule SE forms. If they just file one, typically only the primary spouse listed gets the credit.
Wow. That's a massive practical tip. So one business, but potentially 2 Schedule SEs if both spouses are materially participating.
Absolutely vital. The source also notes if you have multiple businesses, you net the profit and loss from all of them for your SE tax. But you can't combine your net earnings with your spouse's net earnings from their separate business activities when calculating SE tax. Each spouse is figured individually.
Any exceptions to SE tax?
The source mentions notary public fees aren't subject to SE tax. Small detail, but good to know.
Okay, shifting slightly. Yeah. Employee versus independent contractor. What's the main dividing line?
It really boils down to control. The source emphasizes the control test. Does the payer have the right to control what work is done and how it's done? That points towards an employee.
Versus just controlling the outcome.
Right. If the payer only directs the result of the work, not the methods, it leans towards independent contractor. It's a facts and circumstances test, often complex. The source mentions forms workers can use if they think they're misclassified.
Got it. And tips. Definitely earned income.
Yes. And the rule is, if you get $20 or more in cash tips from one job in a calendar month, you need to report all those tips to your employer.
What if it's less than $20 a month from that job?
If it's under $20 for the month from that specific employer, you don't have to report it to them for FICA withholding. But, and this is key, it's still taxable income you have to report on your own tax return.
So it doesn't escape income tax, just the employer reporting and withholding part if it's under $20.
Correct. And if you don't report tips you were supposed to report to your employer, you'll need to file Form 4137 with your return to pay your share of the FICA taxes on those unreported tips.
What about non-cash tips? Like someone gives a server tickets to a show.
Those are taxable income, valued at their fair market value. But the source notes an interesting twist. Non-cash tips are not subject to FICA taxes.
Interesting difference. And finally, fringe benefits from employers.
Yeah, things like health insurance, retirement plan contributions, maybe group term life insurance. Many common fringe benefits are specifically excluded from your taxable income by law.
Not all of them.
Not all. Some fringe benefits are taxable, and if so, the value gets included in your wages reported on your Form W-2.
Okay, let's pivot now. Let's talk about income situations where the money isn't taxed, maybe surprisingly so. Specific non-taxable scenarios?
Military and veterans benefits are a big area here. Combat pay wages earned in a designated combat zone is generally non-taxable.
Hazardous duty pay, too.
Can be excludable if earned in a combat zone, yes. And a really important point. Benefits paid by the VA, the Department of Veterans Affairs, are generally non-taxable.
What, disability payments?
Right. VA disability compensation, education benefits like the GI Bill, pensions based on need, typically tax-free.
Okay. What about life insurance if a beneficiary receives a payout?
The death benefit itself, the main payout from a life insurance policy due to the insured person's death, is generally not taxable income to the beneficiary.
Watch out for interest.
Exactly. If the insurance company holds the money for you and pays you interest, or if you take the payout in installments that include an interest component, that interest portion is usually taxable.
The source also mentions viatical settlements. What's that?
This is where someone who is terminally or chronically ill sells their life insurance policy to a third-party company for cash before they pass away. The funds received from that sale are generally treated as tax-free, similar to the death benefit, under specific conditions related to the person's health status and life expectancy.
So it allows access to funds tax-free while still alive.
Correct. It's a specific, complex area, but provides needed funds tax efficiently in difficult circumstances.
There's also an interesting exclusion for certain payments for providing care at home.
Yes, sometimes called difficulty of care payments, often related to state Medicaid waiver programs. The source highlights this. Payments received for providing care to a disabled individual in your own home.
So the person lives with the caregiver.
That's the key requirement mentioned for this exclusion, yes. Payments for caring for someone who lives in the same home as the provider can often be excluded from the caregiver's gross income.
But you could choose to include them sometimes.
The source notes an interesting option. A taxpayer can elect to treat these payments as earned income if it helps them qualify for things like the Earned Income Tax Credit or allows them to contribute to an IRA. So usually excludable, but sometimes strategically includable.
Disability payments, the tax treatment varies a lot, doesn't it?
It really does. Workers' compensation for a job-related injury, always tax-exempt. Benefits from a private disability insurance policy. Depends who paid the premiums.
How so?
If you paid the premiums with your own after-tax money, the benefits you receive are generally tax-free. If your employer paid the premiums, or you paid with pre-tax money through work, the benefits are usually taxable.
Okay. And disability retirement.
Taxed like regular wages until you reach minimum retirement age, then taxed under pension rules. And VA disability, as we said, generally tax-exempt if service-connected.
Right. Let's switch gears to investment income. Interest is probably the most common.
Definitely. Interest from bank accounts, CDs, corporate bonds, generally taxable. You usually get a Form 1099 INT if it's over $10.
And Schedule B needed if it's over $1,500 total taxable interest.
Correct. That's the threshold for needing Schedule B.
But interest from state or local government bonds, muni bonds, that's usually federally tax exempt.
Generally, yes, that's a major benefit. But here's a nuance the source points out. Even though it's not taxed, you must report the amount of tax-exempt interest you received on your Form 1040, usually on line 2A.
Why report it if it's not taxed?
It can affect other things, like the taxability of your Social Security benefits, as we'll see later. The IRS wants the info, even if it doesn't directly add to your tax bill. Also, note that interest on loans used to buy tax-exempt bonds is generally not deductible.
What about bank promotions? Free coaster? Or maybe $200 cash for opening an account?
The source says those are generally treated as taxable interest income. The value of the gift or the cash amount is reported as interest on a 1099 INT.
But credit card rewards are different, like cashback or points.
Yes, those are usually considered non-taxable rebates or discounts on purchases, not income. Big difference there.
Okay. Dividends from stocks or mutual funds.
Distributions of a company's profits to shareholders. Generally taxable, reported on Form 1099 DIV. And like interest, if your total ordinary dividends are over $1,500, you need Schedule B.
Not subject to employment taxes, though.
Correct. Dividends aren't considered earned income for FICA or ESSN tax purposes.
And the source distinguishes ordinary versus qualified dividends. Why does that matter?
It matters for the tax rate. Qualified dividends get taxed at the lower long-term capital gains rates 0%, 15%, or 20% depending on your overall taxable income. Ordinary dividends are taxed at your regular, usually higher, income tax rate. The 1099 DIV should break this down for you.
What about payments called non-dividend distributions? Box 3 on the 1099 DIV.
Yes, return of capital. This isn't profit distribution. It's considered the company giving you back part of your original investment. It's generally not taxed immediately.
So what happens?
It reduces your cost in the stock. You only start paying tax as a capital gain once these distributions exceed your total basis, meaning you've gotten all your original investment back.
Okay. And stock dividends, just getting more shares.
Usually not taxable unless you had the choice to take cash instead. If it's just more shares, you don't report income. You just adjust your cost basis per share downwards because you now own more shares for the same total investment.
Mutual funds, how does their income flow through?
They pass through different income types. Ordinary dividends are taxed as such. Capital gain distributions money from the fund selling stocks inside the portfolio at a profit are also passed through.
And those capital gain distributions are always
Treated as long-term capital gains for the shareholder, no matter how long you've personally held the mutual fund shares. That's a key rule.
What if the fund holds muni bonds?
If it's a municipal bond fund, the tax-exempt interest it earns generally retains its tax-exempt character when distributed to you.
The source also had a timing rule for mutual fund dividends declared late in the year.
Right. If a fund declares a dividend in October, November, or December, but doesn't actually pay it until January of the next year, you still have to report that income in the year it was declared. A bit of a timing trap sometimes.
And finally, a warning about constructive dividends. Sounded ominous.
Yeah, the source called them BDDD for a reason. This usually comes up in audits of small C corporations. It's when the IRS recharacterizes a payment from the corporation to a shareholder as a dividend.
Like the company paying the owner's personal bills.
Exactly. Or maybe unreasonable salary or a below-market loan. The IRS says, no, that wasn't a deductible expense for the company. It was really a dividend. So it becomes taxable income to the shareholder, and the corporation loses the deduction. Double whammy, essentially.
Okay, definitely something for small business owners to be aware of. Let's shift focus to the assets themselves. Property, stocks. We need to understand basis.
Basis is absolutely fundamental. It's usually your cost, what you paid for the asset. It's the starting point for calculating gain or loss when you sell or dispose of it.
Real property versus personal property.
Real property is land and things permanently attached, like buildings. Personal property is basically everything else: cars, furniture, stocks, bonds, collectibles. The concept of basis applies to both.
And basis isn't always just the purchase price, right? It can be adjusted.
Correct. That's adjusted basis. You start with your initial basis, cost, and increase it for things like sales tax paid on purchase, shipping costs, installation, major improvements, not routine repairs. You decrease it for things like depreciation claimed.
Which brings us to depreciation.
Depreciation is how businesses and rental property owners recover the cost of assets over time. It's an annual tax deduction.
But it reduces your basis.
Yes. Each dollar of depreciation you claim reduces your basis in the asset. This means when you sell, your gain will be larger or loss smaller because your basis is lower. Remember, land itself is not depreciable. The source mentions residential rentals depreciate over 27.5 years.
And the holding period is key too.
Absolutely critical for capital assets. Determine short-term versus long-term. Short-term held 1 year or less. Long-term held more than 1 year, like a year and a day.
Why does it matter so much?
Tax rates. Long-term capital gains get those preferential lower rates, 0%, 15%, 20%. Short-term gains are taxed at your ordinary income tax rates, which are usually higher.
Okay, basis in specific situations. Property received for services.
If someone pays you with property instead of cash, the fair market value, FMV, of that property is income to you. And that FMV becomes your starting basis in the property.
Basis in stocks.
Purchase price plus any commissions or fees paid to buy them. Your broker reports the sales proceeds on Form 1099-B, but tracking your basis is your job. Keep good records. If you can't prove your basis, the IRS might say it's zero.
Yikes. Stock splits.
Don't change your total basis, just the basis per share. If you had 100 shares with a $1,000 basis and it splits 2 for 1, you now have 200 shares with the same $1,000 total basis, meaning your basis per share is now $5.
Property from a divorce. Basis transfers.
Yes, generally. When property is transferred between spouses or ex-spouses as part of a divorce settlement, the receiving spouse takes the same basis the transferring spouse had. It's called transfer basis or carryover basis. No gain or loss is recognized on the transfer itself, usually.
What about gifted property? Is it the same carryover basis?
Usually, yes. The person receiving the gift, the done, generally takes the donor's adjusted basis and holding period. But there's a very important exception.
Yep.
If, on the date of the gift, the fair market value, FMV, of the property is less than the donor's basis, then you have a dual basis situation.
Dual basis, how does that work?
It means your basis for calculating a gain, if you sell it later, is the donor's original higher basis. But your basis for calculating a loss is the lower FMV on the date of the gift.
Wow. What if you sell it for a price between those two numbers, between the FMV at gift date and the donor's original basis?
Then, according to the source, you have neither a gain nor a loss. It falls into a weird neutral zone.
That is tricky. Okay, what about inheriting property? Do you get the deceased person's basis?
No, and this is often a huge tax benefit. When you inherit property, your basis is generally stepped up, or sometimes stepped down, to the fair market value on the date of the decedent's death.
Stepped up basis. So it erases any appreciation that happened during the deceased person's lifetime for tax purposes.
Exactly. If they bought stock for $10 and it's worth $1 when they die, your basis is $1. If you sell it the next day for $1, you have zero capital gain. It's a very significant advantage.
And the holding period for inherited property.
Always considered long-term, regardless of how long the deceased person owned it or how long you hold it after inheriting, guarantees long-term capital gains rates if you do have a gain.
Can basis step down if the asset lost value?
Yes, if the FMV on the date of death is lower than the decedent's original basis, your basis steps down to that lower FMV.
The source mentioned an alternate valuation date option.
Right. This is mainly for estate tax purposes. The executor of an estate can elect to value the assets 6 months after death or on the date of distribution if earlier. If doing so lowers both the total value of the gross estate and the amount of estate tax due. If elected, that alternate valuation date FMV becomes the basis for the heirs.
Okay, so once we know basis and holding period, we can figure out capital gains and losses when we sell.
Exactly. Sell a capital asset investments, home, collectibles, crypto for more than your adjusted basis, that's a capital gain. Sell for less, it's a capital loss. Tax rate depends on short-term versus long-term holding period.
Reporting is on Form 8949 and Schedule D.
Correct. Form 8949 lists the details of each sale. Schedule D summarizes the totals and calculates the net gain or loss.
What if you have net capital losses, more losses than gains?
You can use those net losses to offset your other income, like wages, but only up to a limit.
What's the limit?
$3,000 per year for most filing statuses.
Yep.
If you're married filing separately, the limit is half to $1,500 per year.
Another MFS disadvantage.
It is. Any net capital loss you can't deduct in the current year because of that limit isn't lost forever, though.
It carries over.
Yes, it carries over to the next tax year, retaining its character as short-term or long-term. You can use carryover losses to offset gains in future years and then deduct up to $3,000, $1,500 against ordinary income each year indefinitely until it's used up.
What happens to unused carryover losses when someone dies?
Unfortunately, they vanish. They cannot be passed on to heirs or deducted on the final return beyond the normal annual limit.
Okay, now the tax code tries to prevent people from creating artificial losses. Let's talk wash sales.
Right. This rule stops you from claiming a loss on selling a stock or security if you buy back the same or a substantially identical one within a specific window.
What's the window?
It's 30 days before the sale, the day of the sale, and 30 days after the sale, a 61-day period in total. If you buy within that window, the loss on the sale is disallowed for now.
So sell on Monday, buy back Tuesday, no loss allowed.
Correct. The source notes this even applies if your spouse buys the identical security within that window.
Is the loss gone forever?
No, the disallowed loss is added to the basis of the new shares you bought. So you'll eventually get the tax benefit when you sell the new shares, either through a smaller gain or a larger loss then. This rule doesn't apply to dealers in securities trading for their business.
Okay. Related party transactions also have loss restrictions.
Yes, these rules apply to sales between certain closely related individuals or entities.
Who counts as related?
Your spouse, siblings, parents, grandparents, children, grandchildren. Also, entities you control, like a corporation where you own more than 50%. Importantly, the source notes it does not include uncles, aunts, cousins, in-laws, or ex-spouses.
And the rule is no loss allowed on sales to these related parties.
Generally, yes. If you sell property at a loss to a related party, you cannot deduct that loss.
What if the related party later sells it for a gain?
They get a bit of a break. They only have to recognize gain to the extent it exceeds the loss that you were previously disallowed. So your disallowed loss can shelter their future gain up to the amount of that gain.
Okay. What about securities that become completely worthless, like a stock in a company that goes bankrupt?
The source says you treat it as if you sold it for $0 on the last day of the tax year it became worthless. This determines whether the loss is short-term or long-term. You report it on Form 8949, like any other sale, often noting worthless somewhere.
Any special timing rules for claiming that loss?
Yes, there's an extended statute of limitations. You generally have 7 years from the original due date of the return for the year. It became worthless to file an amended return and claim the loss, which is longer than the usual 3 years.
And the source specifically mentioned crypto again here.
Right. It explicitly states that cryptocurrencies are not considered securities for this specific worthless securities rule. So the process and timing for claiming a loss on worthless crypto might follow different, potentially less favorable rules.
Good distinction. Okay, beyond realizing gains or losses now, there are ways to postpone or avoid tax on property transactions, non-recognition transactions.
Exactly. These are situations where the tax code says, okay, a transaction happened, but we're not going to tax the gain or allow the loss right now. The source highlights 3 big ones. Section 121 for your main home, Section 131 like-kind exchanges, and Section 133 involuntary conversions.
Let's start with the home sale exclusion, Section 121. That's huge for homeowners.
It's incredibly powerful. You can exclude, meaning not pay tax on, up to $250,000 of gain from selling your main home.
And $500,000 for married couples filing jointly.
Right, up to $500,000 tax-free gain. If your gain is under that exclusion amount, you often don't even need to report the sale on your return.
What qualifies as a main home?
It's where you primarily live. Could be a house, condo, co-op, mobile home, even a houseboat, as long as it has sleeping, cooking, and bathroom facilities.
What are the main requirements to get this exclusion?
2 key tests, both measured over the 5-year period ending on the sale date. The ownership test and the use test. You must have owned the home for at least 2 years total within that 5-year window. And you must have lived in it as your main home for at least 2 years total within that same 5-year window. The 2 years don't have to be continuous.
And for the $500K joint exclusion?
You need to file jointly. At least one spouse must meet the ownership test, both spouses must meet the use test, and neither spouse can have used the exclusion on another sale within the last 2 years.
What if you have to sell before meeting the 2-year tests? Maybe for a job relocation.
You might qualify for a reduced exclusion. If you sell due to specific reasons, a change in place of employment, meeting a 50-mile distance test, health reasons doctor recommended, or certain unforeseen circumstances like death, divorce, multiple births, becoming unemployed.
And then you can get a partial exclusion.
Yes, it's prorated based on how much of the 2-year ownership requirement you did meet or how long it's been since you last claimed the exclusion.
What about special circumstances like military service or disability?
Yes, there are exceptions. For military members, the 5-year test period can be suspended for up to 10 years while on qualified official extended duty. For individuals with disabilities who move into care facilities, time spent in the facility can count towards the use test under certain conditions. And rules exist for surviving spouses and divorced individuals potentially inheriting ownership or use periods.
Can you exclude gain from selling just the land your house sits on?
Generally, no. The exclusion applies to the dwelling. However, the source notes an exception. If you sell a vacant lot that was adjacent to your main home and used as part of it, like a side yard, and you sell it within 2 years before or after selling the main home itself, the gain on that land can qualify for the exclusion.
Okay, next big one. Section 131 like-kind exchanges.
This lets you defer paying tax on gains when you exchange business or investment real property for other like-kind real property.
Only real property now.
Well,
Used to be broader.
right. Correct. Tax reform eliminated like-kind exchanges for personal property, like vehicles or equipment. Now it's just for real estate held for business use or investment. You can't use it for your personal residence or property held primarily for resale, like a developer's inventory.
How does it work? Swap one rental house for another.
That's a classic example. Or swapping investment land for an apartment building. It doesn't have to be the exact same type of real estate, just like kind in nature or character. Most exchanges aren't direct swaps, so they use a qualified intermediary QI.
A middleman to hold the money.
Essentially, yes. In a deferred exchange, you sell your property, the relinquished property, the proceeds go to the QI, you identify potential replacement properties, and then the QI uses the funds to buy the replacement property for you.
And the deadlines are super strict.
Extremely strict.
Yeah.
From the day you close on selling your old property, you have just 45 calendar days to identify, in writing, the potential replacement properties. And you must close on and receive the replacement property within 180 calendar days of the initial sale or the due date of your tax return, if earlier. Miss either deadline, the exchange fails, and the gain is taxable.
What if you get cash back or receive some property that isn't like kind in the deal?
That's called boot. Receiving boot doesn't automatically disqualify the entire exchange, but it does make your gain taxable up to the amount of boot you received.
And your basis in the new property is adjusted.
Yes, your basis in the new property is generally your basis in the old property, adjusted up or down for any boot paid or received and any gain recognized. The goal is to defer the gain until you ultimately sell the replacement property in a taxable transaction.
Okay, and the third non-recognition rule, Section 1033, involuntary conversions.
This applies when your property is destroyed, fire, storm, damaged, stolen, or condemned, taken by the government via eminent domain.
If you get insurance money or a condemnation award that's more than your basis, you have a gain.
Correct. But Section 133 allows you to defer that gain if you reinvest the proceeds into qualified replacement property within a certain time frame.
What counts as replacement property?
It generally needs to be similar or related in service or use to the property that was converted. The rules can be a bit more flexible for condemned business or investment real estate.
Are the replacement deadlines like the 1031 exchange?
Generally longer. For destroyed or stolen property, you usually have 2 years after the end of the first year you realize any gain. For condemned business or investment real property, it's 3 years. For a main home in a federally declared disaster area, it can be 4 or even 5 years.
Do you need a qualified intermediary here?
No, a QI is not required for a Section 133 deferral. You just need to acquire the replacement property yourself within the deadline. Your basis in the replacement property is adjusted to reflect the deferred gain.
What if your main home is condemned or destroyed? Do you use the Section 121 exclusion or Section 133?
You might be able to use both. The source indicates you can first apply the Section 121 exclusion, $250K, $500, to the gain. If your gain exceeds the exclusion amount, you can then use Section 1033 rules to defer the remaining gain by reinvesting those excess proceeds into a new main home. It gives you flexibility to maximize the tax benefit.
Okay, great overview of those major non-recognition rules. Let's move on to income from property use, rentals, and royalties.
Rental income payments for letting someone use your property usually reported on Schedule E.
Usually. When is it not scheduled?
If you provide substantial services, like in a hotel or bed and breakfast situation, transient lodging, that's a business reported on Schedule C. Renting out personal property, like tools or a car, also goes on Schedule C if it's a business, or Schedule 1 if it's just an activity for profit but not quite a full business.
What about common rental situations, advance rent, security deposits?
Advance rent is taxable when you receive it, no matter what period it covers. Lease cancellation payments are also income when received. Refundable security deposits are not income initially. They only become income if you keep them due to lease violations.
Getting property or services instead of cash rent.
Taxable at the fair market value of what you receive. But if those services were for something deductible anyway, like repairs, you'd have income and an offsetting expense.
What if a rental property sits vacant? Can you deduct expenses?
You can't deduct the lost income, obviously. But yes, you can generally deduct the ongoing expenses, mortgage interest, taxes, insurance, utilities, repairs, and, importantly, depreciation, as long as the property is genuinely available for rent. Even during periods you're fixing it up between tenants if it was already a rental.
But repairs before you first rent it out.
Those are different. Repairs made to get a property ready for its first tenant generally have to be capitalized, added to the property's basis, not deducted immediately. Depreciation starts when it's ready and available for rent, placed in service.
Rental income is usually passive income.
Right.
Right. And passive losses are limited.
That's the general rule. Passive activity losses, PALs, can typically only offset passive activity income. Any excess passive loss gets suspended and carried forward to future years.
But there's that special $25,000 allowance for real estate rentals.
Yes, a major exception. If you actively participate in your rental real estate,
Meaning what?
owning at least 10% and making significant management decisions, approving tenants, setting rent, approving repairs. If you meet that, you might be able to deduct up to $25,000 of rental losses against your non-passive income, like wages.
Does everyone get the full $25,000?
No, it phases out based on your modified adjusted gross income, MAGI. The full $25K is available if your MAGI is $100,000 or less. It phases out completely once MAGI hits $150,000. For married filing separately who lived apart all year, the limit and phase out are halved.
So higher earners might not get this benefit. Suspended losses can be used later.
Yes, if your income drops back into the range in a future year or when you eventually sell the entire property in a fully taxable transaction,
What about renting just part of your home, like a room?
you have to allocate expenses, mortgage interest, taxes, utilities, insurance, depreciation between the personal part and the rental part, usually based on square footage or number of rooms. And there's a key distinction if your personal use is too high.
The residence rule.
Right. If you use the property personally for more than 14 days or more than 10% of the days it's rented at fair market value, it's treated as a residence.
And if it's a residence rental and you have a loft on paper?
Your deductions for the rental portion are limited to the amount of rental income you receive that year. You can't use the excess expenses to create a loss against your other income. The disallowed expenses carry forward to potentially offset future income from that specific property.
What if you're clearly not renting for profit? Like renting to your cousin way below market rate?
That falls under the hobby loss rules. The income is taxable, Schedule 1, but expenses are deductible only up to the amount of that income. No loss deduction allowed and no carryover of excess expenses. Very different from a for-profit rental.
And the minimal rental use rule, under 15 days.
The vacation home loophole. If you rent out a property considered a residence for fewer than 15 days total during the year, you don't report any of the rental income, and you don't deduct any rental expenses other than things like mortgage interest and property taxes you could deduct anyway if itemizing. It's basically tax-free income for very short rentals.
Nice little perk. Okay, royalties.
Payments for the use of your property, often intellectual property, copyrights, patents, or natural resources, oil, gas, generally reported on Schedule E.
And generally not subject to SE tax.
Correct. For most royalty recipients, you usually get a Form 1099 MISC.
But there's a big exception for creators.
Yes. If you're a self-employed writer, artist, inventor, etc., and the royalties are from your own work,
Then it's treated like business income.
exactly. Reported on Schedule C and is subject to self-employment tax because it's derived from your business activity. But if you inherit royalty rights, that income goes on Schedule E and is not subject to SE tax.
Okay, let's do some other miscellaneous income sources. Taxable recoveries.
This happens when you get money back that you deducted in a prior year, and that deduction actually saved you tax. The classic example is a state income tax refund.
If you itemized deductions the year before and deducted state taxes.
Right. If you itemized and got a tax benefit from deducting state taxes, then receiving a refund of those taxes the following year is taxable income up to the amount of the benefit you received. It's reported on Form 1099-G. If you took the standard deduction instead, the state refund is generally not taxable.
Alimony. Big changes here recently.
Huge changes. The key is the date the divorce or separation agreement was finalized.
Before 2019.
Agreements finalized before January 1st, 2019 are grandfathered under the old rules. Alimony paid is deductible by the payer and taxable income to the recipient.
And agreements finalized in 2019 or later.
The rules flipped. Alimony is not deductible by the payer and not taxable to the recipient. Completely different treatment. For payments to be alimony under the old rules, they generally had to be cash, required by the agreement, and at the recipient's death, etc.
Child support is totally different, though.
Completely. Child support is never taxable to the recipient and never deductible by the payer, full stop. If a payment covers both alimony under an old agreement and child support, it's treated as child support first.
And dividing up property in a divorce, like the house or investments.
Generally not a taxable event. Basis usually transfers, as we discussed earlier.
Social Security benefits, taxable or not.
It depends. Up to 85% can be taxable depending on your provisional income.
Which is?
Half of your Social Security benefits, plus all your other income, wages, pensions, interest, dividends, including any tax-exempt interest.
Tax-exempt interest counts here, too. Wow.
Yes. It can push more of your Social Security into the taxable range. You compare that provisional income to thresholds based on filing status.
What are the thresholds, roughly?
For married filing jointly, taxability starts around $32K of provisional income, maxing at 85% taxable above $44K. For single head of household, it starts around 25K, maxing out above 34K. Married filing separately, if you live together, has a $0 threshold, so benefits are likely taxable right away. It's a multi-step calculation.
Okay. And supplemental security income, SSI, is different.
Yes, SSI is a needs-based program and is not taxable, different from Social Security, retirement, or disability benefits.
Gambling. Win big at the casino.
All winnings are taxable income. Report everything. You might get a Form W-2G if winnings are large enough.
Can you deduct losses?
Yes, but only up to the amount of your winnings for the year. And gambling losses are an itemized deduction on Schedule A, so you need to itemize to claim them. You can't deduct a net gambling loss.
Canceled debt. Can that be income if a credit card company writes off your debt?
Generally, yes. Forgiven debt is usually considered taxable income. You might get a Form 1099-C.
Are there ways out of that? Exceptions.
Several important ones. If you're insolvent, meaning your debts exceed the fair market value of your assets right before the cancellation, the forgiven debt isn't taxable up to the amount of your insolvency. Debt discharged in bankruptcy is also generally not taxable.
What about mortgage debt on a main home?
There's a special exclusion for qualified principal residence indebtedness, QPRI. Forgiven mortgage debt on your main home can be excluded from income up to certain limits. This provision was extended through 2025.
And student loans.
A big one right now. Due to the American Rescue Plan Act, most student loan debt forgiveness occurring through the end of 2025 is specifically excluded from federal gross income.
Also, if the debt would have been deductible if you paid it.
Right. If paying the underlying debt would have given you a business deduction, for example, then having that debt canceled generally doesn't result in taxable income for cash basis taxpayers.
Hobby income versus business income. We touched on this with rentals.
Same principle applies elsewhere. If it's a hobby, not primarily for profit, the income is taxable, Schedule 1. Expenses are deductible only up to the amount of that income and only if you itemize as a miscellaneous itemized deduction subject to limits, which makes them hard to deduct currently. No loss allowed, no carryover of excess expenses, no SE tax either. Crucial to show profit motive to be treated as a business, Schedule C.
Court awards and prizes. What's taxable, what's not?
Awards for lost wages or profits, generally taxable. Punitive damages, meant to punish, always taxable.
What about damages for injuries?
Compensatory damages received for personal physical injury or physical sickness are generally not taxable. This can include related emotional distress damages that stem from the physical injury. Damages for purely emotional distress without physical injury are usually taxable. The source also notes damages for wrongful incarceration are non-taxable.
And winning the lottery or a prize.
Taxable at its fair market value. Report on Schedule 1. The source mentions you might avoid tax if you formally refuse the prize or arrange for it to be donated directly to charity without you ever taking possession.
Okay, almost there. Quick look at education savings impacting income. Scholarships.
Non-taxable if used for qualified education expenses, tuition, fees, books, required supplies, and you're a degree candidate. If it covers room and board or it's payment for teaching research, that part is taxable.
529 plans, qualified tuition programs.
Great savings tool. Contributions aren't federally deductible, but earnings grow tax-free and withdrawals for qualified education expenses, K-12 tuition up to limits or higher ed, are tax-free. No income limits to contribute. Taxable distributions get a 10% penalty on earnings.
Iverdell ESAs, education IRAs.
Similar concept, different rules. Contributions $2K max per year per beneficiary aren't deductible. Earnings grow tax-free. Qualified distributions, K-12 or higher ed, are tax-free, have income limits for contributors and age limits for beneficiary, usually contribute before 18, use by 30. More investment options often than 529s. Taxable distributions also hit with a 10% penalty on earnings.
Okay. We've journeyed through a ton of income types. Before we wrap, let's revisit those adjustments to gross income, the above-the-line deductions. Why are they so good?
They're powerful because they reduce your gross income before you even get to AGI. Lowering AGI can help you qualify for other deductions and credits. And crucially, you get these adjustments even if you take the standard deduction you don't need to itemize. They're on Schedule 1.
What are some key examples the source mentioned?
The educator expense deduction. Up to $300 to $600 MFJ if both eligible. For K-12 educators' unreimbursed supplies. HSA contributions. Deductions for putting money into a health savings account if you have a high deductible health plan. Tax deduction going in, tax-free growth, tax-free withdrawals for medical costs, triple tax advantage. Deductible part of self-employment tax. You get to deduct 1/2 of what you pay in SE tax. Helps offset the burden. Self-employed health insurance deduction. Deduct 100% of health insurance premiums for yourself, spouse, dependents if your business has a profit, subject to limits. Cannot take if eligible for an employer plan. Self-employed retirement plan contributions. Deductions for contributions to SPs. Simples, qualified plans. Student loan interest deduction. Deduct up to $2,500 of interest paid on qualified student loans. Alimony pay deduction. Only if the divorce agreement was pre-2019. Traditional IRA deduction. May be deductible depending on your income and whether you have a retirement plan at work.
And others like moving expenses for military, penalties on early CD withdrawals. Quite a list.
Yeah, they all chip away at that gross income number before you get to AGI.
Wow. That really was a deep dive. We went from the basic definition of income all the way through specific assets, transactions, and those final adjustments.
It seems complex, and honestly, parts of it are complex, but breaking it down, understanding the core concepts like basis, holding periods, earned versus unearned, exclusion versus deduction, it makes it manageable.
Our goal was really to pull out those key nuggets from the source, give you that foundational understanding so you feel more empowered navigating your own finances.
Absolutely. It's not just about filing taxes once a year. Understanding how different income is treated impacts decisions about investing, saving, running a business. It touches everything.
So a final thought to leave you with. Now that you've heard how differently various types of income and transactions are handled by the tax system, how might this knowledge actually change the way you approach your own financial decisions? Was there one specific rule or distinction today that really stood out or surprised you? Something to think about.